Have you ever wondered why companies suddenly change how they record inventory? Or why depreciation schedules sometimes shift midlife? Today, we're breaking down a crucial financial reporting topic: accounting for changes. Specifically, changes in accounting policies and changes in accounting estimates under IFRS and ASPE. Here is what you are going to learn: how to identify policy versus estimate changes, when to apply retrospective versus prospective treatment, IFRS versus ASPE differences, key disclosures, real-world examples. This is a big topic on the CPA exams, in practice, and in financial reporting interviews. So stick around. But before we jump in, make sure to like this video, subscribe to the channel, and hit the notification bell so you never miss a new lesson. All right, let's jump right in. In financial reporting, there are two types of accounting changes we're focusing on today: change in accounting policy and change in accounting estimate. These can be accounted for prospectively or retrospectively, and that decision really matters because it affects prior financial statements, retained earnings, comparability, and what users see. Prospective means going forward only, while retrospective means we restate past periods as if the change always existed. Now that we understand the two broad categories, the next question is, how do we know which one applies? Let's walk through that. To identify the type of accounting change, ask yourself three key questions. 1. Was the change made by choice? If yes, then it's likely a policy change. Use retrospective treatment. 2. Is the change required by a new IFRS standard? If yes, then follow transition guidance. And 3. Is new information driving the change? If yes, that's a change in estimate. Use prospective treatment. And here's a great rule to remember: if you can't tell whether it's policy or estimate, treat it as an estimate. Now that we know how to identify the change, let's go deeper into each type, starting with changes in accounting policy. A change in accounting policy happens when a company switches from one acceptable method to another. This only happens when the new method provides more relevant and reliable information, or a standard requires the change. For example, FIFO to weighted average, cost model to revaluation model, switching between IFRS and ASPE for private companies. The key point here is, policy changes are usually applied retrospectively, so past financials look like the new method was always used. That sounds straightforward, but it leads to an important challenge. What if restating the past isn't realistically possible? Let's address that next. Sometimes we simply cannot restate prior periods. Maybe fair values weren't tracked, or historical data doesn't exist. In that case, if restating prior periods is impracticable, apply the change prospectively. Explain why it was impracticable and from when the change applies. Let's bring this to life with examples so you can really cement the concept. A company switches from first in, first out to weighted average to improve comparability. Inventory values change. COGS changes. Retained earnings adjust, net of tax. This is a voluntary policy change, so you use a retrospective application unless impracticable. Now let's look at a second example where retrospective application isn't possible. A company shifts from cost model to revaluation for land, but doesn't have past fair values. That makes retrospective application impracticable, so revalue now, record revaluation surplus in OCI, apply change prospectively. Okay, we've mastered policy changes. Now let's move to the other side of this topic: changes in estimates, which work very differently. Estimates change when new information becomes available, not due to error. Examples include useful life or residual value of an asset, warranty and legal provisions, bad debt allowance, decommissioning obligations. These are always applied prospectively. Here are two real-world style examples to make this crystal clear. A company originally estimated $2 million to decommission a site in 10 years. New regulations push that to $2.5 million. That's new information, so the increase is recorded prospectively. Equipment initially depreciated over 10 years. Later, data shows it will last only 8 years and have a residual value. So you calculate NBV at date of change. Adjust depreciation for remaining life. Apply prospectively. So we now understand both policies and estimates. But what about disclosure requirements? Policy change disclosures are nature of the change, amount of adjustments by line item, cumulative effect, reason for voluntary changes, explanation if retrospective restatement is impracticable. Estimate change disclosures are nature and amount of the change, impact on current and future periods. If future impact is unknown, disclose that. We also need to understand how this differs between IFRS and ASPE, so let's break that down. Both IFRS and ASPE treat changes in estimates the same way. They are always applied prospectively because they're driven by new information. The real difference shows up when we talk about changes in accounting policy. IFRS has a stricter set of rules, while ASPE gives private companies more flexibility in specific cases. So think of IFRS as full disclosure and full consistency, and ASPE as practical and flexible where appropriate. ASPE allows changes without proving better information for specific cases like subsidiary consolidation methods, development costs, income tax methods, and convertible debt treatment. All right, now to bring everything together. At this point, we've seen examples, journal entries, and the logic, but it's always helpful to end with a clean summary so you can instantly recall the rule in practice and for exam situations. Think of this section like your mental cheat sheet. If you ever feel unsure whether a change is prospective or retrospective, or whether it's a policy or estimate, this table settles it. So your decision pathway is simple. New information, change in estimate, prospective. Better reporting approach or new standard. Change in policy, retrospective, unless you literally can't apply it. All right, that's all for today. Master this topic and you strengthen both your CPA exam confidence and your real-world accounting skills. If you found this breakdown helpful, hit subscribe, drop a like, and comment below. Which topic should I cover next? Thanks for watching Canada Accounting Insights, where we turn complex accounting into clear learning. See you in the next video.